This video is for entertainment purposes only and is not financial advice. Hey guys, welcome back to another video. My name is Josh. In today's video, we'll be doing a portfolio update on my Sharesies public portfolio for the month of January 2022. So this month's update will cover 2 months worth of price movements, as well as that we've seen the market being quite volatile, especially towards the downside. So it'll be interesting to see how this portfolio has stacked up against the benchmark. So I've recently started tracking my portfolio using Sharesies, which allows me to very quickly and easily track my portfolio performance. So I'll be showing you how the performance is measured on Sharesies later on. We'll also talk about my investing strategy for this current stock market climate, given that we've seen a lot of volatility, a lot of uncertainty, a lot of fear in the market. So I'll share with you how I'm thinking about investing in this current situation. If you enjoyed today's video, be sure to hit like and subscribe. And as always, none of this is financial advice, not a recommendation for you to buy, hold, or sell any of the stocks mentioned in this video. So with that out of the way, let's get right into the video. So here we are on the Sharesies dashboard. You can see that the portfolio value of the public portfolio is $23,706. The total returns currently sit at 2,975, representing a simple return of close to 13%. So as you can see, the portfolio has downtrended quite a bit, even though I've been adding more money into it. Oh, decided to do a refresh. But you can see at one point in time in late October, the portfolio was sitting at a $5,700 gain. At the moment, it's sitting at 2,600. So we've seen the portfolio value contract quite significantly. So if you're in the same boat, do not worry. Many of us are also experiencing the pain in the market. In terms of the positions, nothing much has changed. I still hold the core 8 positions. That is Auckland International Airport, Collins Foods Limited, Heartland Group Holdings, Infratil, Kogan.com Limited, Macquarie Group Limited, Oceania Healthcare Centre Group. So the obvious worst performers are Kogan.com Limited, down 41.23%, as well as Oceania Healthcare, which is the largest position, ironically, down close to 11%. Now, let's take a look at the portfolio on Sharesies, because as I mentioned, it's very easy to track your performance against a benchmark. So over here I have my Sharesies public portfolio against the NZX top 50 ETF benchmark. And as you can see, the alpha that the portfolio has generated in October, the gap between the index performance and my performance has narrowed recently. So that does show that the portfolio has underperformed. Now I can change the view as well to the last month. And this shows how the portfolio has performed, and as we expect, the portfolio has underperformed the NZ Top 50 ETF. So portfolio has returned a loss of 9.25%, whereas the FNZ ETF returned a negative 0.99%. The worst performer on the ASX side of the portfolio is Kogan.com Limited. So Kogan is considered a more speculative growth type stock. And as you know, growth stocks were impacted the most by expectations of rising rates. So Kogan obviously got sold down. It's actually one of the most hated stocks on the ASX. It has one of the highest short interest in the market. And recently they did release a January update, which disappointed many people in the market. Gross margins contracted, as well as revenue didn't grow as quick as people expected. So that led to Kogan selling down. Now I'm going to review my position after the half year results full release. So that will be sometime in the next few weeks. All right, now looking onto the NZX, we see that Oceania is the worst performer. So Oceania continued its downslide from when I talked about why they were dropping a few months ago, I believe. Oceania Healthcare, the number one issue is rising costs. And when you have a situation like Omicron, that will cause costs to rise even more. So depending on how long Omicron plays out, Oceania might continue to suffer higher costs. Now, in terms of the price action, however, it fell to as low as $1.12. So I did manage to buy some shares. And as you can see over here, looking at the all trades report, it shows all the transactions that I've made over the past 2 months. So I did manage to buy some shares in Oceania Healthcare on the 19th of January 2022 at $1.27. And then 5 days later, it dropped to $1.14. So I managed to scoop up some shares there as well. So this allowed me to reduce my average cost on Oceania Healthcare and taking advantage of the dip. I also bought some shares in Center Group at $3.03. So Center Group currently sits below $3. So I'm sitting on a loss on this current position. However, I'm not too worried because I'm a long-term holder and not too worried about monthly fluctuations. So if you've seen your portfolio dip by about 10%, just know that you're not alone, and chances are people will probably feel something similar depending on how much growth you have in your portfolio. So my portfolio, I don't consider to have significant growth. However, Oceania Healthcare was also hit hard because, healthcare stocks will face rising costs, and rising costs eat into your profits, so that's why a lot of healthcare stocks have dipped as well. The portfolio underperformed the general benchmark, but I'm not too worried. This is, in my view, a short-term impact on the main stock, which is Oceania Healthcare. And once Oceania Healthcare rises again, we'll see the portfolio outperform the benchmark. So hopefully we'll see that sometime soon. Now let's talk about my strategy in investing in the current climate. In a climate where we hear a lot of news about, interest rates, about macroeconomic indicators, and you have people talking about technical analysis. If we breach this point, the market will go down to this point. It gets all very complicated, and this can be a lot of noise, and most of the time this noise is not useful for you. Now, I've been reading a book, Richer, Wiser, Happier by William Green, and in page 116 there's a very useful page on filtering out through the noise. So it says over here, complexity can be a particularly seductive trap for clever people. They were rewarded at school for solving complex problems, so it's no surprise if they are drawn to complicated solutions when confronted by the puzzle of investing. But in financial markets, as in martial arts, victory doesn't depend on dazzling displays of esoteric techniques. It depends on a firm grasp of the principles of the game and a deep mastery of basic skills. As Buffett has said, business schools reward difficult, complex behavior more than simple behavior, but simple behavior is more effective. Buffett himself is a grandmaster of simplification. Writing to his shareholders in 1977, he laid out his 4 criteria for selecting any stock. We want the business to be one that we can understand, 2, with favorable long-term prospects, 3, operated by honest and competent people, and 4, available at a very attractive price. These may not strike you as earth-shattering secrets, but it's hard to beat this distillation of eternal truths about what makes a stock desirable. More than 40 years have passed, yet Buffett's 4 filters remain as relevant and as useful as ever. So that's definitely something to think about. So in terms of my strategy, I'm looking to simplify, find something that's undervalued and buy it instead of trying to time, when the market will bottom. Because the thing is, no one knows where the market will bottom. And by the time we get there, it's probably already too late for you to buy at the bottom. So my plan is just to find undervalued securities and buy them. And as well as that, I'll implement a dollar cost average strategy to my purchases. So I won't buy them all at once. I'll buy them over time because the market is very volatile. And if you find an undervalued stock, it might be 30% cheaper the next week or the next month or the next year. So we don't know how long this will go out for. So if you implement a dollar cost averaging strategy where you always keep cash on hand, this gives you power from a psychological benefit, right? Because if you think about it, if you have cash, you feel like you're in a position of power and you can take advantage of dips. But if you're fully invested and the market drops, then you can't really do much but hold. So implementing a dollar cost averaging strategy will give you a psychological benefit over other retail investors. And the stock market is more of a psychological game than a mental game because people mostly act out of fear, and when they act out of fear, they tend to underperform. So another thing is that people say cash is trash, but at times like this, cash is actually useful. Cash allows you to buy anything you want as long as you have enough of it. So that's why I always have some cash on hand so that you can take advantage of the dips. Now, in terms of where I'm looking in the market at the moment, I think the risk reward of certain growth stocks look very, very attractive. Now, I'm not looking at growth stocks that are hugely speculative, that are just a concept stock. They don't actually have a product yet. I'm looking at stocks that have a great product, great management team, as Buffett has mentioned in his 4 criteria, right? We want a business that we understand, good business, good management team, and at an attractive price. So I'm looking for those characteristics on these businesses, and the businesses that I'm looking for, I want them to have high operating leverage so that when their revenue grows at, say, for example, 30, 40, 50%, their profit tends to grow at a higher rate than that because they have a lot of their costs fixed, so any increases in revenue will translate to a much higher profit. And I also want these companies to be close to break-even point, because what's happening right now is that the market is punishing stocks that are not profitable, but at the same time there are some stocks that are close to break-even that are also sold down 40, 50, more than 50% as well. So these stocks, in my opinion, have the chance to give you the highest alpha over the next 1, 2, or 3 years. So over the next year, I might underperform given that some of these growth stocks might continue to get hit by expectations of higher interest rates. And for someone that has a long-term horizon, I can stay invested for the next 1, 2, 3, 4, 5 years, then short-term movements like this really give me a very good opportunity to dollar cost average into some high quality names that have been unfairly beaten down. So these are the stocks that I'm looking for. I'll give you guys another update in February on the stocks that I've bought, but I'm doing a lot of research right now to find which stocks to buy given this opportunity. So let me know what you guys think of this update. If you're looking at any stocks or you've recently bought some growth names, let me know in the comment section down below. Be keen to hear your thoughts as well. So thank you guys for watching. Until next time, guys, take care.